Hey everybody, Mike DeAndre here. Today is November 17th, and I want to share with you some observations that started with some shocking news last week, and it has some implications for where we are now and where we might be in the future. So wanted to take a moment and share some charts and some ideas with you. So last week, on Thursday, we had the everything rally. Stocks, bonds, the dollar, gold, commodities, oil, everything was up. Okay, and everything we wanted to go down actually went down. So US dollar went down, the interest rate on the 10-year note went down, and the VIX went down. Why did it go down? What implications does it have for us moving forward as we come into the seasonally strong part of our year? And what are we going to be watching to help us be on the right side of what happens next? So let's start with this. What happened? So inflation happened, interest rates happened, and the dollar happened. So let's see in what way these things were going on. So here is a chart going back to the 70s looking at core and headline inflation. And as you can see, there have been some pretty interesting periods, in particular the 70s, and in particular right now. So this is the world that we live in today. It's not particularly attractive as it relates to inflation, but it's kind of our lot in life right now. And the good news is it's rolling over. Now, how persistent will this rollover be? We don't know. Is it going to go sideways? Is it going to go down? Is it going to go up from here? But what has to happen is for it to stop going up, or excuse me, for it to go down, it has to stop going up, right? So right now, it is cresting a little bit. And it looks like it might be in store for a bit of a pause, if nothing else. So when inflation is going down, it sends some signals to the rest of the market. And those signals are kind of echoing through the 10-year note. Here is the interest rate going back to February, which this is up and to the right in a very strong way, a very quick, strong, meaningful move in the 10-year note, peaked at 4.32, and again rolling over here down to 3.692 today. This pullback, as it was in the summer, can be very helpful for equities. And if you remember, we talked in our last video about not anticipating a strong equity rally unless the dollar and the 10-year pulled back. Well, that's what we have right now. The green line here is the dollar, and the 10-year is the red and black candles, and you can see they're really highly correlated. So they're moving in lockstep throughout this year, and they're moving in lockstep on the way down. The dollar began pulling back a little bit quicker, albeit, but still, that is the state of where things are today. So what happens next? What happens next is going to likely be revealed through what happens in the VIX, what happens in the price action of the broad indices, and what the Fed does. So let's take a look at how that plays out. So here we have a long-term view. This goes back to 1991 of the VIX. And there are generally persistent periods of low volatility like these yellow blocks, and then high volatility like these red blocks. We are currently in a high volatility period. So we want to take a little look here and see what clues the VIX may give us for the next move in the market. So if we look back, this goes to 2020, 2021, and 2022. Again, we're still on the VIX. This is a weekly chart, so every candle represents 1 week of price action in the VIX. And here we have the COVID spike, and then sort of this long, persistent dampening of volatility into the teens. And then the VIX hasn't really spiked. You know, it's gone to 40. Well, it's hit a 40 a number of times over the last couple of years. It's hard to really call this a spike because we don't have that sort of Eiffel Tower look in the way that it's behaving. It was sort of a pop and then this persistent little glide down throughout the year. But what's been really sticky is this 20 area, or when volatility has dropped sufficiently to bring the VIX down to 20, we get a reversal. We get a spike of volatility. So here we want to keep an eye on the VIX to see, will this trend continue down? Will we get into the 20 area? And then once we're there, are we going to bounce higher, or are we going to actually begin to crawl lower? We also want to keep an eye on the price action of the S&P 500. This is going back to March of last year. Here is the beginning of the year, 2022, and then that persistent sort of claw down in the S&P, and it's sitting in this area of constipation, let's just call it that, right around 4,000. Okay, I was going to say consternation, but I think constipation fits better. So we're 39.46 on today's close in the S&P, and this, between 4,000 and 4,250 is some highly contested real estate for the S&P 500. So if we take a longer view in the price action of the S&P, going back about 40 years here, a little over 40 years, we're looking at a monthly chart of the S&P. And the 50 period moving average is this sort of light line here moving forward. And you can see the majority of the time, the instances where the S&P may pierce the line, but it quickly recaptures and then continues to make new highs. So it comes down to the line or pierces the line and then makes new highs. Twice in the dot bomb and in the Great Recession, it fell below that line and led to significant drawdowns in the S&P. Okay, but in the majority of the cases, it bounces and moves higher. So if we zoom in, we can see that we pierced in COVID, ramped higher. We've pierced so far. That's more of a love tap maybe than a pierce, but it is nonetheless held that support line so far. That's something in the positive column. If you're bullish on equities or want to be long or want to participate in the rallies that could come from growth in equities. It's not an all clear. It doesn't mean we're out of the woods yet, but it is a step in the right direction. So we're seeing these little baby steps as we move forward and closer to year end. So another piece of confirmation, and of course you all know this is the BPMB NYSE right here. So that is the bullish percent multiple buy signal on the NYSE. So when we see green columns of X's going up and then highlighted X's in green, that's telling us that stocks are presenting consecutive multiple buy signals. Okay, that's a good thing. When we see the white space with the highlighted red letters, that means that we are not getting, or fewer and fewer stocks are presenting multiple consecutive buy signals. And so when we're looking for confirmation and we're looking for follow through, this is an excellent chart for us to look. And again, it's a good thing when we see dark green X's on this chart. What's an example of that? So if you look at 2017, which was a very low volatility year. The market didn't really have much volatility at all in 2017. You can see the multiple buy signals. This would be an excellent example of a chart and of a market that is showing tremendous confirmation and strength through the use of multiple buy signals. Okay, the Fed. Now, as we are looking at the effective funds rate going back to the 70s, we can see that we are right down here. Okay, 2023, 2022, this range on the chart, that is our current situation. There was a news release this morning, or a speech given by the Fed, the St. Louis chair, asking for 5 to 5.25 as the terminal rate. If we look at probabilities of the next Fed raise, CME Group does a sort of takes the temperature of the market participants to see where they think the next rate increase in this case is going to be, and the probabilities are with a 50 basis point increase in the Fed funds rate over a 75 basis points, which have been the last couple rate hikes. In fact, we're about 80% probability is what the market is expecting. If the Fed's going to not raise by 50, you could look for more press releases, more speeches, maybe some leaks to some news organizations that would come out and begin to chatter that, hey, you should be looking for 75, and hey, maybe they're going to do 75, something along those lines, because they don't necessarily want to kind of forecast accurately and prepare the market. At least that's been the game plan so far. But today the market's expecting a half-point cut. Is that a half-point raise? Is that a full-on pivot? No, but it's a step in the right direction. Looking forward, what do we need to keep our eyes on? So we need to be looking for the VIX. We need to always keep our eye on price. And we want to see what the Fed is going to be doing with their next announcement. So please have a wonderful, wonderful holiday. I hope that Thanksgiving is a great time for you and your family. And if you have any questions, please feel free to reach out. Thank you and enjoy it. Take care.